Morning, Larry. Absolute pleasure to be on the show with you, mate. Looking forward to our chat today. How did I find Bitcoin? So, you've covered off. Very thankful for the introduction. So you've covered off a lot of the sort of background to how I found Bitcoin. So I'm an electrician by trade, and in Australia, tradespeople generally make a fairly decent wage. So I was in a after sort of living hand to mouth for years and years and years, I got to a point in my life where we were thinking about my wife and I at the time, starting about thinking of family and really looking around the landscape of what we were doing from as far as careers and wages at that point in time, and had a complete pivot, had a complete shift, and decided I wanted to be an electrician. So this was around the age of 29, and basically dropped everything and moved into starting an apprenticeship with the idea of being able to get a job, get a career that was going to sustain the family lifestyle. So sort of fast forward, long story short, and the apprenticeship years were very brutal for the young family. We did have starting kids by then, so wife stopped working, went down to one wage, and apprentices don't typically get paid all that well for those 4 years while you've got to sort of put in that proof of work, right? But then the light at the tunnel is you come out the other side and you can earn a fairly decent wage, which is directly tied into your output, right? So, overtime, if you want to, pick up the extra shifts, pick up the extra work, then you're directly compensated for that, right? So, and that was the end goal. So if we fast forward a bit longer, a bit further down the track, then we'd finally started to earn an okay wage. I'm a musician as well, so I had a little side hustle where I'm, just going to the local pub and doing gigs and swapping my spare time for extra income. And then we were in a fortunate position to start looking at, well, we've got excess than what we're spending. What do I do with this now, right? And I think, like, fundamentally, I knew putting money in the bank didn't serve me. Never has, never did. And without knowing about inflation and knowing about this erosion of your purchasing power by putting money and saving in what they call money, saving in currency, I wasn't conscious of these issues at the time, but I always knew that every time we tried to put money in the bank, it didn't really work, right? So I turned to investing. And I knew nothing about investing. I knew nothing about bonds or equities or, macroeconomics or any of these fancy terms. So I told myself that I would do a full 12 months worth of study. At that point in time, I was studying an engineering degree, and I was at a bit of a fork in the road in my formal study. So I'd completed a Bachelor of Engineering in Electrical and Electronics Engineering, and there was a pathway forward to continue study. Or I said, well, I was doing 20 hours worth of study a week in engineering. So I said, what if I point that towards investing? So that's what I did. I just didn't know where to start, but just grabbed a couple of books, a couple of the classic sort of books, like from Peter Lynch, One Up Wall Street, The Magic Formula. That really resonated with me around value investing. So that was sort of my dipping my toe in the water about this concept, like value investing. And then the further I read into value investing, the more that resonated with me. That made sense. Let's try and find companies that are deemed undervalued, that have good balance sheets, who are, it's the same sort of principle in and around if you were to go and buy a coffee shop in your local neighborhood. You'd want to go and have a conversation with the owners. You'd want to go and find out how many cups of coffee are you selling, what's your cost basis, what's your profit margin, what are your overheads, how many staff do you have. You'd really want to know how that business performs. And what I think by this stage, what I sort of found funny is having conversations with some older gentlemen at work. Not a lot of people know, a lot of people invest in equities to try and get ahead, but not a lot of them know what they're buying. So they're buying on a whim, right? So, a typical conversation with one of these elder gentlemen would be, I bought BHP Billiton yesterday, massive mining company in the ASX 200 here in Australia. I bought that share yesterday. I said, oh, why would you buy that? And he said, oh, because it went down 6% from yesterday and it's going to go back up, without any further due diligence around what that company's actually worth. And I think this is where people, investing in equities, they're abstracted from value. They don't know what that company is actually worth. So by the same token, you would do that due diligence for a coffee shop. Why aren't people doing that due diligence when they look at equities? So I continued on on that education journey, gave myself a full 12 months and learned how to read balance sheets, learned how to read accounting statements, learned how to read cash flow statements, and taught myself how to do discount cash flow analysis to try and value an equity. And so I got to this point where I'd done a fair bit of work there. So this is circa 2018 into 2019. I'm still saving some of this excess, hadn't deployed any yet, and I'm starting to get a really good understanding of what it's going to take to start investing. So this 12-month period went by where I'd read quite a few books, listened to a lot of podcasts, subscribed to some, financial publications like Real Vision, which was really invaluable and helping me sort of understand the investing landscape. And I had these spreadsheets, Google spreadsheets that using Google Finance formulas would bring in the tickers, bring in the price for all of these companies. I had the ASX 200, a good portion of the ASX 200 on a spreadsheet, some Japanese stocks, some of the US S&P 500 stocks. And I would run this discount cash flow analysis formula across them to try and see what was at fair value, what was, what could I possibly investigate further in order to buy using this value investing sort of framework, which made a lot of sense to me, resonated with me. But what I'd found, Larry, was that when you dig into that, there wasn't a lot of companies to buy. All of these companies were trading at multiples of what would be deemed fair value by any other accounting metric. So I thought, well, I've done something wrong, right? So first instance, as an engineer, you go back and you check all the formulas and check all your processes and make sure that there's no error in there. Turned out I couldn't identify an error there. So I started peeling back the layers and like, well, how is this formula working? And one of the quick realizations was when you're comparing any other asset in the world, you're always comparing against the risk-free rate of return. So just to give your listeners who aren't familiar with that term a little bit of background on that, what is the risk-free rate of return? And it's typically the US Treasury bond, right? And the thesis is if I can lend the US government money and I can get a coupon, an interest rate for lending them money, that's my risk-free rate. And they call that the risk-free rate because, quote unquote, they should be able to, they've got access to a money printer. So they will never, never, in quotes, default on the payment of that bond because they can print it out of thin air, right? And that's the thesis. So if I'm going to get back my principal, I just clip the coupon on the way through, collect my interest rate, and they'll always be able to turn the printer on and pay me what they're due at the end of that bond maturation. So when I'm looking at this risk-free rate of return, and we're talking 2019 now, and we're starting to look at these reverse repos and all of this complex stuff that's happening on in the back end. I'm doing a bit more digging, and I start to realize that risk-free rate of return is highly manipulated. So, and they do that through controlling of interest rates and money printing. And when you really start to think about that, it's a really quite a diabolical system that we work within when there's a group of men behind closed doors that can dictate the cost of capital. Right. And just to circle back to the point, that risk-free rate of return then, as that approaches zero, when you're looking at these discount cash flow formulas, as that risk-free rate of return approaches zero, your willingness to pay a premium for other assets when you're comparing that trends to infinity. They're directly in opposition. As one approaches zero, the other goes to infinity. And when you're comparing then against that risk-free rate of return, that's really starting to, like when you're looking around this investment landscape, looking at all other assets, it's very, it doesn't take much to draw the conclusion that we're not operating within a free market. And if you're not operating in a free market, it's really, really, really difficult then to find, level water in terms of, well, what should I be paying for other assets? Yeah. So once I'd then discovered how money printing actually works, so that was the next logical step is like, okay, if this is true, and my assumption's true that this is not a free market and they can control interest rates, by what mechanism do they do that? So further study into how, into macroeconomics essentially and how money works, how money flows, how capital works, how money gets produced back into the market, and we start to discover some really quite concerning trends in and around the feedback mechanism that ensures that that will more than likely continue into the future. And then we fast forward through to COVID. Okay, so we have a global shutdown, and so 2019, I'm ready to start buying things, but there was nothing to buy. In quite honesty, there was a couple of companies that would have come in, out of the ASX 200 at that time. There was 3 companies using my formulas that come up as, from what I was assessing, which would have been over 100. What that came up as fair value, and then when you look a little bit deeper, they were cheap for a reason. They had like very bad debt levels and all those other, so they weren't purchasable. So you fast forward to 2020, and we had COVID hit, right? And I sort of was keeping abreast of macro trends, and was really quite appreciative of a guy named Dr. Chris Martinson, who came on the Macro Voices podcast early 2020, and he said, look, I don't think the world's really understanding what this COVID thing could mean. Like, we could be talking global shutdowns and all that sort of thing. And it was at that point where I took everything back to cash. So I was, there was all my retirement account, any positions that I did have on by that stage, I'd rolled them all back to cash, and I was just waiting. And then we locked down, and Australia had a pullback in the market, and it was somewhere in the vicinity of 46 to 50% drawdown in equities. And little Daz is rubbing his hands together. This was my time to shine, right? I was excited. Like, as bad as that sounds, that was the emotions going through. It was like, the world's looking like it's imploding, but hey, I'm going to be able to clip my ticket, right? I'm going to be able to pick up some good equities.
There's blood on the streets, as we say. When there's blood on the street, it's time to act, isn't it?
Exactly right. So I was frothy. I was ready to go, and could you believe, Larry, that after that 46% drawdown, that same basket of goods I was monitoring at 100 plus stocks out of the ASX 200, there was only 6. So 3 more companies that come up, and that was really when I started to go, okay, something's fundamentally wrong here. Like, how bad is this? Like, so I was already on that journey. I was already reading about things like, I was pretty much a gold bug by then,
Right.
And I was starting to read about why gold failed. So if I'm a gold bug, why did gold, when I was starting to read about money and the fact that we left the gold standard in 1971, and starting to really piece this together, started learning about Bitcoin as well. Because the thesis was, okay, well, why did gold fail? And there's a couple of reasons we can dig into. Like, what I discovered there was the fact that, we started opening up. The world started opening up, global trade, globalization, outsourcing manufacturing. And this was all fed back, right, through a fiat monetary system in a way as well. So when we left the gold standard in 1971, arguably money was backed by gold till that date. We'd had some times throughout history where we'd gone off the peg, back on the peg, mostly through wars. But largely we were on this Bretton Woods system where, so Bretton Woods, the respect was, the thesis was there that the US had all the gold, right? After World War II, a lot of the gold inflowed into the US. They sat down, we said, well, we're in trouble. All our central banks around the world don't have much gold left. What are we going to do with our currency systems? And the idea was the US would back their currency to gold. Everyone else would back their currency to the US, and we had fixed exchange rates. We fast forward to 1971, Vietnam War. There was a lot of other in macroeconomic markets and this banking system, the Euro banking system. They started to really put pressure on that gold backing. Okay, the US started printing more than what they had in reserves, and some of the other countries started to wisen up to this and said, hey, what are you doing here? We know that you're expanding that peg. We want our gold back. We don't want the useless notes. We want the gold. And that's where Richard Nixon in 1971 pretty much said, no more. I'm gonna, no longer will the US dollar be redeemable for gold. And from that point forward, we've been on fiat money. So most countries in the world just print money out of thin air now. Okay. So what sort of led to that, though, why gold really failed, was this idea around it not being able to keep up with technology. And there's an inherent trust system that needed to be sort of enacted, like US with a central bank. And the problem is with gold, like you can't trust anybody in this world. And there's another really good example of why you wouldn't trust a centralized system with maintaining the gold peg, and that's the Bank of International Settlements. There's a book called The Tower of Babel, illustrates this quite well. It's all about the Bank of International Settlements. World War II, Germany invades Czechoslovakia. Bank of International Settlements had, the story goes, they had vaults, and like, here's Czechoslovakia's pile of gold, here's England's pile of gold, here's, Germany's pile of gold, and so forth. Germany invades Czechoslovakia, gets in contact with the Bank of International Settlements, and just says, hey, yo, that big pile of gold that's got Czechoslovakia's name on it, that's now ours. And the Bank of International Settlements says, okay. And that's as far as it goes, right? That's obviously a very simplified version, but that's why gold fails, right? Is this notion of having to have either physical settlement of gold, so if France and France and Japan are trading, and France needs to settle a debt, a trade imbalance with Japan, and they need to settle in physical gold, they have to weigh it, ship it, secure it, send it over there. Then Japan, do they trust France? Probably not. So they've got to recast it, remold it, count it, weigh it, and all that process is very, very expensive and super slow, anywhere from 6 to 12 months to sort of do that. So that's why, gold's not a great form of money in terms of a bearer settlement instrument in a globalized world that has instantaneous and speed of light transactions on the internet, right? That's really the abstraction that we need to sort of get comfortable with. And it needed a replacement. So the next best thing was fiat currency. So you could have these paper claims started to be easier to transact in, because no one wanted to do physical settlement, and no one wanted a centralized body controlling the ledger, right? Controlling the balances, because we've already proven that model doesn't work. So when we get digitized, that abstraction just becomes a whole lot easier, because now we don't even need the physical bills. Now we can just represent that with zeros in a bank account. And so essentially money is just a ledger, right? And Lynn Alden talks about this. Highly recommend the book Broken Money if anybody's listening and interested in it. Is a full history on money, and she puts up a really good framing I hadn't really thought about in the past, whereas money is essentially a ledger. It's always been a ledger in some way, shape, or form. It's this notion of credits and debits and checks and balances, and we can go right back to cavemen, right? So me and Larry are running around in the bush. I make a kill, I drag the woolly mammoth back, and we all eat, right? And we chalk up on the cave wall, on the cave painting, hey, Daz made a kill. Now Larry owes Daz a kill, right? And we start this notion of credits and balances and social credits. And that's essentially the fundamental level around how money works. Is how do we as humans navigate our world and communicate value to one another? So if Larry was just sitting there not going out and shooting and or making the kills and sharing the feed, he'd quickly be ostracized from the tribe. It's like, no, you've got to put your proof of work in, Larry. You need to be contributing to the tribe in some way, shape, or form. Otherwise, you're just dead weight and we're going to cut you loose. So that's really the fundamental thesis around what is money, is that notion of how do we communicate value. And when we go to the next iteration, which was barter, we started to specialize in our own skill set. So, maybe I was the really good hunter, but maybe you were a good farmer, Larry. Your skill wasn't in taking down the mammoth. Maybe you could grow grains or potatoes or something like that. So, if I made the kill, we could then start swapping. So I might have had, farming practices improved. I might have had chickens. You might have had apples. It's this coincidence of wants then comes to fruition around, do you need apples and do I need, or vice versa, do you need chickens and do I need apples at the same time that we're swapping? And then if that wasn't true, we needed an intermediary, a medium of exchange in the middle of that, in order for us to settle that trade. So maybe you didn't need chickens when I needed the apples. So what is it that we can settle on that we both find valuable, that we can put an inherent amount of trust in to be able to swap later on? And that's where we started to see commodity type monies. So we started to see salt, we started to see beads, we started to see seashells, just these things that were deemed valuable, whether they had an intrinsic value or not. It was a socially acceptable medium by which we could park our value to return another day to swap for those goods and services. And it just turns out that the scarcer and the harder to produce those commodities were, the better they served as money. So we started to then evolve into precious metals. So copper, silver, gold, these types of things that we knew we couldn't just create out of thin air, that were somewhat scarce, that were somewhat durable. And, you know, the other advantages of precious metals is we could melt them down and we could start to put them into coins and put stamps and put values on them to help us communicate that value metric. And then so you've got a physical bearer asset. You know, I transfer that value to Larry. He's got it in his hand. I've got no claim to that anymore. He's parking that value in that medium, and he knows that it's got somewhat of value in the community. It's socially acceptable. He can come back at a later date and swap that for another thing of value. And that's really what money is a store of your energy, a store of that value, so that you know you can go and you can trade that energy for something else later on. But we've still got a ledger. It's still a ledger in some sense, because I've had to expend value. I had to expend energy and provide value in order for somebody to want to swap whatever I was doing for that token. But it's still essentially a ledger. It's still a claim to energy in the future. So when we sort of now fast forward back to sort of, I'm conscious that I'm sort of going back in loops here, but when we've gone to this physical bearer instrument then, and we're talking about how do I send that at the speed of light to the other side of the world, when we've got now global commerce on internet rails, on communication rails, how do I settle that bearer instrument? That's really where fiat currency, I think, really started to take off. So we started printing, right? Sometimes that gold and a lot of value stored in precious metals was actually really cumbersome to deal in. So we started looking at these promissory notes. We'd park our gold in a warehouse in a secure vault. They'd issue us a paper note for that money. And then we would go, and Larry and I would then both know that that's redeemable for gold. And it's just as good. So rather than, if I'm going to buy a horse off Larry, rather than me going back to that store, getting the gold out, coming to Larry saying, here's the gold, Larry, only for Larry to put it back in the same store and get the same note, we started to build a bit of trust in that system whereby you would freely accept the note rather than us having to go back and leave the gold where it was, because that paper was just as good as the gold. So that's where fiat money and paper money really started to proliferate. And humans are humans. What the bankers started to notice was that, hang on, only like 10% of the people, right? And that's a number I've picked out. Well, let's call it 20%, 30%, whatever that is. There's only a small percentage of people who are actually coming back for the gold. What if we just issued an extra note, you know? And this is really, and you can go back. So Murray Rothbard's, I think it's A History of Money. There's a book that goes right through this, and right back with examples of back to like 1800 with the Bank of England. I think the first central bank was in Amsterdam, then the Bank of England in the UK. And this example was in and around the Bank of England of them issuing more notes than what were in circulation. And the really funny thing is they got caught, but there was no precedent in law. So they got away with it. And it was starting to see what those extra notes in circulation were doing for the economy. One man's spending is another man's income. So it created extra jobs and all that. So there was a lot of, when they're looking at it, they seemed to deem that there was a lot of economic benefit from having a fractional reserve system. And that's really our first fractional reserve system was perhaps we can have a peg and have extra notes in circulation, which is basically the credit system. You know, right. You've got the physical, and then we can just have a fixed reserve, but we can introduce some more notes into the system, and we can get all of these economic benefits from being able to control that peg and control that reserve ratio. So that was the birth of fiat currency. And then when we get right through to 1970s and onwards, and we start opening up, we start digitizing our payment rails, that promise of the promissory note, the paper note, is a fractional reserve system built on top of a fractional reserve system. So we're extracted away from gold, we're extracted away from value, and we're on a paper currency system. But now when we look at our banking system on a digital rail, that fractional reserve system only used to have to exist on the paper notes. So we've gone 2 abstraction layers deep in what is actually money, what is actually something that stores value. And now we can pretty much have a ledger that's centrally controlled by each bank. So when I've got a bank account, which is just a digital representation of the money, right, that I have in that bank account, it's really just zeros that's controlled by, and everybody's got their own ledger. So we don't have a global ledger. We don't have a global system that upon what we all agree. So the trust system is that my bank says I've got X amount of zeros in my bank account. I'm trusting that they've kept that ledger up to date, and then when they're dealing with other banks, that other bank has their own ledger. And then we've got central banks that they have their own ledger. And we've got this global system of basically millions of ledgers that are an inherent amount of trust that are in. And essentially, when you look back to how do they introduce and control those units, it is not even money printing anymore. We say money printing very loosely. They actually don't even fire up the printer. All they do is add an extra zero to the balance sheet. And that's where we are in a monetary system. And so when I started to learn about Bitcoin, that's where it started to make sense. What are all of the properties that made gold really valuable? Scarce, hard to produce, tied to energy, all these things. But what are the things that made gold fail that Bitcoin fixes? And one of those things is a globally distributed ledger. And that's really where this all ties right back into what is money. It's essentially a ledger. And Bitcoin is the best form of money because it's the best ledger that we've ever discovered. And how that works is that everybody who chooses to run a node and participate in that network has a copy of that ledger. They've got a copy of exactly how many Bitcoin are in circulation and to whom, what addresses, those pseudonymous addresses, who owns that Bitcoin. And it's all protected through cryptography. So if you want to move Bitcoin, you've got to have the keys. You've got to, it's all provably protected by energy and mathematics that you can't co-opt, you can't change the history, and we've got it globally. So I've got a copy of that ledger. Larry, you've probably got a copy if you're running a node, and we check each other. We check each other all the time to, hey, is Larry's the same as mine? And as well as all the other tens of thousands of nodes that are publicly available for me to connect to and check that history. And that's really, I realize I've probably gone on a half-hour rant here, Larry, without you saying much, and around how I discovered how I discovered money. But essentially, that was the path, coming from value investing through to really discovering how money worked. And then, well, if that's money, if that's what I'm told is money, what's the history of money? And how did that all change? And how did we get to where we are today? And then ultimately, at that juncture in my life around value investing and finding what do I do? When I discovered that my money is losing purchasing power, I've got to go out on the risk curve. I've got to go out and invest this. What are my investable options? But it's a vicious little feedback mechanism that is not, we are so far removed from what is true value that there is really nothing else in the world I want to own except Bitcoin.
Yeah, same here. I've come to realize that a few years ago. Yeah, and it's just amazing. I was involved in property. I had gold, had different things. It's all that's turned into now. So
exactly.
But
and I mean,
what I'm thinking as well, there's a lot of people still around me and that I meet that think gold can be or will be used like as some type of a currency in the future, or they can go out and buy different things with it. They're buying these gold coins, and why are still people going down that road? You know what I mean?
I mean, we're fickle.
The thing about me, I cannot, for the life of me, figure out how you can transact gold or silver. I can't figure that out. How we're going to transact this if things go really, really bad, which they look like they're going to go really, really bad because we're in a death spiral.
I 100% agree. And I think like we're fickle beasts, us humans, right? We like hoarding. Like, everything's precious to us. So that I get the thesis in and around gold and silver and precious metals. It's something I can hold. It's something, sort of tangible in the physical world that I can keep my hands onto. But there's a few properties of why people find value in that is it's the notion of scarcity, and it's the notion of energy, that it takes energy to create them. And so that there is the store of value, right? We've got to expend energy to dig it out of the ground, to find it, to mine it, to cast it, all of those things. And it's something tangible I can hold on to, and it's shiny and it looks pretty, right? So there's a couple of things in and around that. But I think you hit the nail on the head in terms of why it potentially won't work into the future, is because we are an ever expanding world. And when you are dealing in finite and scarce things, the real big challenge to that is this notion in and around, if you've got an ever expanding world of production, of people growing, and you've got a finite scarce asset, divisibility really does become a big issue. And so I don't know if anybody has actually ever bought gold, right? But for, in Australian terms, $3,800 or something now is an ounce of gold. It's about the size of a 5-cent piece. How do I buy a loaf of bread with that? Divisibility really does become an issue. And I mean, we've had monetary metals in the past. And I think what's really interesting to note is that the more industrial utility a metal has, the worse it is as money, because it has other industrial uses. Money should be money. Money should have its own monetary premium and not an industrial premium. And that's why we don't use copper for money today. And that's why we don't use silver for money today. And gold is still arguably one of the things that central banks hoard, right? Because it has less industrial uses, is more scarce than those other things, because they actually have utility in other, both copper and silver are great electrical conductors. They carry energy, they carry electrons really, really well. So the more industrial uses they have, the worse they are as money. And that's where Bitcoin really, all of the properties of what makes gold a great money, like we've alluded to already, the scarcity, the durability in terms of it just being a ledger and globally distributed, it's incredibly durable. But the real key takeaway is it's the visibility. We can buy fractions of a Bitcoin. So one Bitcoin goes down on the base layer protocol, goes down to 10 to the negative 8. That's 8 decimal places. So you can buy a fraction of a Bitcoin. One Satoshi's worth, I don't even know what it is, 0.1 of a cent, I think, in Australian terms.
Oh, yeah.
Or even
But
one
0.06 something of a dollar at the moment.
Exactly. So you can buy a loaf of bread with Bitcoin, and potentially, because it's so divisible. So that's why gold, if we're looking at these other metals and we think, well, they've got an industrial utility, there's competition for them as a metal. And like silver's a good example. We used to have silver coins, right? But at some point, the value of the silver exceeded the minting face value of the coin. Okay. And that's the problem with precious metals, is when we've got a finite expanding world and we've got a scarce asset, that scarcity, that value, that will accretion that it starts to appreciate in, needs to be divisible against the things that you want to buy. And that's why gold will ultimately only ever get worse as a money, because we're starting to really pack in a lot of value into quite a small, tiny little item. So if we're going to tokenize that, right, that's a logical solution. We just put it in a bank and we tokenize it, but we're right back to square one. We're right back to having to trust a centralized body to do all the checks and balances, and we shouldn't, because history has proven no central body will do that in a trustless way. And that's really the value prop for Bitcoin here, is then if we're going to take this notion around having a digital commodity, how do we make it finitely scarce? How do we make it divisible? How do we make it portable, transactable, all of these things that make money useful? How do we do that in the digital realm so that we can settle trade from one place to another with zero trust in any central body? And that's really where Bitcoin has come to light. And I think anybody who hasn't, the next logical question for most people, right, is why Bitcoin then? And why not all of these other billions of cryptocurrencies? And really Bitcoin takes advantage of first mover advantage in terms of network effects. So it's like Wikipedia. Larry, you and I can go and start our own version of Wikipedia tomorrow. We can go and copy and paste all of that, but how do we get everyone to say we're the new copy of Wikipedia? That's essentially what we've got with these other cryptocurrencies. We had Wikipedia, which is Bitcoin, and we've got all these competing ones to say, hey, I can make some tweaks and balances and make this better for a variety of reasons. But there's always trade-offs in engineering. There's always a trade-off. If you're going to optimize for security, you're going to trade off on centralization. There's this trilemma between network effects, security, and there's always a trade-off in that circle in and around what they're trying to do to be different. But ultimately, Bitcoin is that Wikipedia that's gained too many network effects to be competed out anymore. There's too many people using it, too many people really piling in. And I think the bigger key thing to focus on out of that argument is centralization. When you look at all of these other cryptocurrencies and you start to really look under their lid to say, well, why not Ethereum? Why not all of these things? They're not money. Bitcoin does a ledger, a blockchain, right? It's essentially a ledger, and it does one thing and one thing really well, and that's money. Otherwise, it is a very, very expensive database. Okay. So when they're starting to say, oh, we use this blockchain technology, it's the buzzword, and we're going to do all of these other things, there are
all these
terrible
other new
trade-offs.
things. Yeah, all these other new things that are coming on board now, like whatever, and different people have different opinions of them, like ordinals and memes and whatever else they're bringing on. Like, yeah,
Absolutely. And that's not to say there might not be some value in blockchain, like tokenizing assets or something like that, but they're not money. They're not competing. Bitcoin's out here, these other things. And when you tear the lid off those other things, most of the time, if you look under the hood, they're centralized schemes. Okay. And that's a broad brush, and that's probably a triggering thing for anyone who's curious. But really, I do implore you to dig under and say, if you're going to own something that's not a security, right? And this is why securities laws really come to the fore. Like, regulation, and like a lot of Bitcoin maxis will say, oh, get rid of the state, get rid of all of this. And I totally get some of those arguments. However, regulation is good in terms of avoiding people getting scammed. There's a regulatory body, and that can be co-opted, and there's plenty of nuance in that discussion, which we don't have to get into. But most of those cryptocurrencies are unregulated securities. It's some company who says, we've got some value proposition, or what we think is a value proposition. Let's go and issue tokens so we can get money in, so that we can do things and build this out. And we can issue that on a blockchain without any regulation, but on a promise that token's going to provide value to something later on. But when you look into how they all work, there's a centralized body. They've probably done a pre-mine, which means they've issued tokens to themselves. They've said, well, let's issue a gazillion of these tokens, but let's keep 50% of them to ourselves, issue the rest of them, gain a heap of money, and then we can start influencing crypto markets, and we can start basically separating hard-earned wage earners from their money. And that's essentially where I take a lot of exception to crypto, is the fact that, the system that we operate in is really, it's a diabolical system in which people don't know they're operating in. And most wage earners are getting fully extracted, like all of their value is getting extracted. And they're finding it harder and harder. Both mum and dad work, 10-hour days. Kids are in daycare. We're eroding the family unit. We're really, people can't even save for a deposit for a house, let alone buy the house. They're struggling to even put enough money away to get a deposit because asset prices just keep going. And we're really getting into this financial nihilism, this sense of, I have no other options than to go to the casino. And that's where these cryptocurrencies really get framed up, right? The shining lights and hey, I've just gone up a gazillion percent today on the basis of nothing. It's a meme, these dog coins that do nothing. But people are in this position now where they've been financially eroded. They've got this nihilism about them where they think, I have no other choice. And when they finally come onto Bitcoin, right, and they log into these altcoin casinos, they see the flashy lights and they're like, well, maybe I'll just buy this dog coin and roll the dice, because all I've got left, I don't have two sticks to rub together at the end of the week. All I've got left is $10. What's $10 going to give me? I may as well go and roll the dice at the casino. And that's why I take a lot of exception to crypto, because it's basically just, in my mind, 99.9% scams. People who know that they can take your money from you. And most of the people that are playing in those markets are people who think that they can get ahead by playing and essentially just gambling.
Yeah. And a lot of them like as well, but it's down to the education as well, though, Daz, isn't it? People need to learn that because a lot of people come to Bitcoin or to crypto for the money. You know what I mean? Let's not lie about it. That's why a lot of us maybe came into this, and a lot of us fell down the hole of this crypto scam as well. And but we're after brushing ourselves off, and we're after coming out on the other side. And we said, okay, you know, there was something wrong here. Maybe I should go back and have a look at Bitcoin. You know, and another thing as well, once you do your homework, you start really getting into your head. Don't trust, just verify everything. Don't trust and verify. So a lot of Bitcoiners are on the ball. You know, we don't trust policymakers. We don't trust what's on the media. We don't trust, you know, I mean, what the CMO is saying to us, the chief medical officer is saying to us, different things. We just verify and we go start going digging ourselves, you know.
Well, history is just a narrative, and I think money, really, we've been lied to for
Yeah, we
decades,
have been, and
and that's
that's the bottom line, isn't it? We've just been totally lied to about the money and about a lot of other things as well around us.
That's right. And you know, when you say something as fundamental as the communication medium by which us as humans extract and communicate value, that erodes how we show up in the world. And it erodes how we see value, what we're doing. And if they can lie to us about money, it just goes to show that, well, maybe I should be suspicious of most other things. And that's what I really appreciate about the Bitcoin community and that whole don't trust, verify notion is we take nothing for granted anymore. And it's, well, if you're going to tell me something is true, I'm going to take some further steps to actually question that and tell if you're telling me the truth. Because if you can lie to me about money and you can lie to me about, you know, how inflation's good for me, then arguably what else would you lie to me about? And that's what I think is really an important takeaway and a good life lesson for me is it's not that we're all running around with tinfoil hats on about, you know, all of the conspiracy theories that exist in the world, but by all means we'll question them and we'll say, is there any validity to these? You know, and
we will
that's one.
investigate them. We'll investigate them ourselves. Yeah, you know,
Yeah.
and we'll keep on digging and digging and digging. And that's what I think a lot of other people have to do for themselves. But it's not for everybody. And
Yeah.
people
And I
haven't got the
think,
time to go and probably look the way we are. You know, my whole life has changed in the last 4 years. You know, I had a
nailed
big
it.
business, nearly 120 people working for us, madness, you know what I mean? And then COVID hit, and it just gave me the time actually to sit back and see what was going on. And when I discovered in 2020 that they were printing 20% of the total amount of money that was ever created in Europe, I said, this can't be true. This can't be true. And I just started looking and looking and looking and started learning about money. And I said, yeah, it is. Well, we need to do something and protect our family.
And sometimes I think those M1, M0, M2, and M3 money supply charts are enough to orange pill most people because those charts go flatline for the last 100 years and then they just go absolutely parabolic. And I think when it's a really easy sort of notion then to say, if you've got a finite amount of goods and services in the world and we introduce more currency units to compete with that same service number of services, products, and goods, then of course that leads to higher prices because we've got more units competing with the same amount, you know. And I think those charts are really important to share with people because that's like, well, okay, now I understand why we've got inflation because you can't just do that. You can't print money. You can't print value out of thin air. And that's essentially what they did is they diluted overnight every
Yeah.
single person's output by just introducing extra currency units. And it's the same, you know,
But the thing
as,
about it is they're doing it year on year. And every year they're
yep.
doing more and more and more. So
And
as
they
I
have to.
say, yeah, but yet to keep it all going.
Yeah. And we've got such a global debt problem that our tax revenues, like particularly in the United States, like usdebtclock.com, I think is
Yeah,
you can Google
madness
US
it
debt
is.
clock and you just look at this
Yeah.
debt clock flicking around and our ability to pay off just the interest on that debt is starting to be exceeded. We can't even pay the interest expense on that debt with tax receipts that exist at the moment. So
But
they're
like,
going to keep printing.
yeah, when you look at it, last year in June, and they were saying America was going to close down, it was at 31.5 trillion. Now it's about to hit nearly 35 trillion. It's gone over 34.5 trillion. So they're really increasing the debt by 1 trillion every 90 days, more or less. $1 trillion, which is unbelievable.
And that so they
And
put these spending
there's
bills
no
out.
accountability. There's no accountability
Nope.
for all these people that are doing this. The so-called government are meant to be looking after people and protecting everybody. And they say, oh, we're doing it for your own good, but we need it for this, we need it for that. Who voted for it?
Yep.
Did you vote for all the money printing in your country? So they
No,
can send lumps of it away to different countries and do different other things and not look after their own country. It's madness.
It is madness. And this is where I take a lot of exception to it, because like it's eroding families. Like that's really one of the inflation is forcing both mum and dad to, I mean, I'm sure most mums and dads, like give it whoever wants to, right? I'm sure most people want to spend more time with their kids, but this notion of both mum and dad having to work full-time jobs has been celebrated. Like, it's really been, oh, it's great that women have got careers, and that is great. If that's your choosing and you want, I love that there are options for women to go and, equal opportunity for them to learn and have a career and all of that sort of thing. But ultimately also, I really like the ability for people to choose whether that's actually what they want, where they want to be spending their time. But I think a lot of particularly women, and this might come across as sexist, and I apologize for that, but this is
Yeah,
what
but
I
it's not meant
appreciate
to be
about
though. It's not meant to
it's
be
not
though.
meant to
We
be.
we understand what's going on, and a lot of people don't understand what's going on. A few years ago, and not too long ago, you know what I mean? My dad could have gone out there and worked, you know what I mean, and provide for three or four of us, have a lovely house, a nice 3 or 4 bedroom house, have a nice car outside, you know what I mean? And my mother looked after us, and we were a nice close family. Look what's going on now. You know what I mean? The kids have been dropped to creche in the morning. The two parents are out all day. The kid doesn't see the parents till maybe 6 or 7 o'clock. He gets to spend 1 hour, an hour and a half, you know what I mean, with the mother and father. The child is tired. There's no proper quality time. It's just all madness what's going on, and people are just accepting all this, except
Yeah,
for
and I
some
think
people
like
like us that
this
copped
younger
on.
yeah, well, exactly. And that's why I'm passionate about the education piece in and around trying to help my people, like my wage earning friends and family, try and wake up to this. Because you look around, and most mothers would want to spend time at home. We've been really lucky and made some trade-offs and some sacrifices in order to be able to manage that a bit better for my personal family. I've got two young boys and a wife. She works part-time, school hours, a couple of days a week. But she's got time to do the other things because, and this is where, people start fighting about money. They start fighting about output. They start, we're all flogged. We get home and we still got to do dishes and laundry, and you're not helping and you're not helping. And you get this
Causes
really quite
tension and
vicious.
stress and everything, doesn't it?
It's
That's what it does.
absolutely terrible. And then we've got this generation of children that are basically being brought up by their peers and by centralized bodies who dictate the messages that these kids get. Okay. And this has happened right through from birth. So,
Yeah.
mum might have a couple of months at home if she's lucky, then she's got to put them in daycare. These kids are developing peer relationships, not parental bonds, because they're simply not there. And when mum and dad get home, they're busy, they're tired, they got to get dinner ready, they got to get school ready, blah, blah, blah. They're not spending that quality time at all. So we're growing up with these children with a real detachment from their families and from their parents, and they turn towards their peers for support, for development, for it should be the mum, it should be the dad.
Yeah.
But
Yeah.
and then it's an easy conclusion then to draw when we look around all of this confusion in and around this younger generation of coming up who are absolutely frothy about like socialist policies and stuff, because that's what they've been basically indoctrinated to believe
And
from a young
conditioned
age, and
from a very, very
they've
young
been
age. Yeah.
conditioned.
And the
Exactly.
system is there. to do all that and to line them all up to their way of thinking. And a lot of people mightn't think that, because here's the thing, you don't even know what your kids have been taught in school anymore. You have no idea.
Well, that's why we put my wife into the school, right? So we could keep on top of it. So she actually works at the school. So because we want to
Happy
make damn
days.
sure. But I mean, we're getting to a point, next year we're pulling our kids out for a year and we're going to go around Australia. And this is what I love about Bitcoin, is that it's given me and my family that option. Like we do have optionality. And ultimately that's what, I don't think Bitcoin's a get rich quick scheme. It's it's money how grandma used to say money worked. You work hard, you save the excess, you minimize your expenses, you put it away, and you come back later on to say, now what are my options? What do I do with this money? And we don't have to be forced into going out on the risk curve in terms of finding risky assets, because real estate, real estate in particular is a risky asset in my mind. Equities, they're risky, they're all risky assets. Bitcoin, when you tear under the hood, it's really not. I see it as the most riskless asset you could possibly own. It's only seems risky because it's new, but ultimately it's the most provably, decentralized asset that is easily verified and easily provable. You just look under the hood and you say, is it still working? TikTok next block. We can see all these metrics to look under the hood to say there's nothing wrong with the system. All of this FUD, all of these 20% drawdowns that have been, if nothing's broken, then my thesis hasn't changed. I've just got to zoom out and I come back and I've got to not take a short-term view in the short-term volatility. Volatility does not equal risk. Volatility equals opportunity for people to be able to, take advantage of this volatility. But ultimately, if you save in small chunks every single day or every single week, whatever that means for you, you can iron out that volatility for yourself and you become the line of best fit. So if we've got a whipsawing effect on a price, but we can buy it in little chunks, we're basically taking, as much as we can into the derivative. We're taking out the instantaneous rate of change and we're just buying as often as we can, and we become the line of best fit, the average exposure to that. And if you zoom out, all you have to know is that it's not broken, and you come back in 4 years' time and you see what options it's given you. And ultimately, that's what Bitcoin means for me, is optionality. It's given me, a humble little electrician, the ability to critically assess my life and say, hey, my kids are really young. They're 7 and 10 years old, 8 and 11 by the time we leave. I'm going to give them an experience that they're going to remember for the rest of their lives. We're going to take 12 months. We're going to jump in a little caravan. We're going to go around Australia. That's what Bitcoin's provided me, that option to do that. I look back 5 years. That wasn't an option for me. I was going to be on this hamster wheel for the next, until I'm 70, until the government tells me I can access my retirement account and they can tell me I'm allowed to retire, is essentially what I was waiting on. So if nothing else, it's given me optionality. And ultimately, that's why I'm passionate about the education space, why we started Looking Glass Education, why we wrote the book Beers for Bitcoin, is because I look back at my path in the last few years and the options that Bitcoin has given me. And in its simplest form, Bitcoin is the simplest, most riskless asset in my mind that everyday people can get access to. And when I look back at the journey that I've taken through that, wage earners should not have to do that. Wage earners should not have to know about monetary history, about macroeconomics, about, discount cash flow analysis. I'm an electrician. I should not know how to do discount cash flow analysis on a stock. I should not know how to read an accounting sheet. I'm an electrician. I should go out, wire houses, install electrical apparatus,
But
and come home.
you were pushed down that lane because what you were seeing was happening to yourself, and you started learning yourself, and you started really getting deep into that, and then that opened your eyes up to what is really going on.
100%. I'm definitely grateful for the journey, but when I look back on it, and this is why I think most everyday wage earners don't do that self-development, because they're too tired. They've been flogged. They've been, they get home and all they've got, once they've sorted the kids' school, the lunches, the washing out, they sit down for an hour of mind-numbing Netflix before they go to bed, and they got to do it all again. So that's why at Looking Glass we thought that
let's
was our
talk a little
approach.
about Looking Glass. Let's talk a little bit about that so we can help other people that see this, and let's drive them to Looking Glass so they can get some education. the
Love
same as
to.
it's changed our lives. So let's talk about Looking Glass, about who's involved, part of the team. Open her up.
Yeah, great. So going back about 4 years now, so I started all of this knowledge that I'd sort of started to accumulate through my own self-development. I was having a lot of conversations. I work with a lot of different crews, so it was a lot of different tradies, discussions around the smoko table and and like I said at the start of the call, generally electricians make a fairly good. So a lot of us had income to be able to look at investing. It's kind of topical that most people, you know, had someone to investing in some way, shape, or form. So those conversations then were in and around. Well, hang on. If I've gone down this education journey, it wasn't evident that everyone else was starting to tear back the deeper layers in and around how money worked and the system that we're actually trying to navigate through. So as I was sharpening my sword in terms of those conversations, the next logical step for me was well, how do I reach more people with that message? It's clearly that it's resonating with a lot of people. So I started writing articles and just putting them up on Medium, sharing them amongst, Facebook groups with friends and family, and started getting a lot of traction. There's also some crypto groups and some investing groups I was a part of. Started putting these in there. I was getting a lot of good feedback, and then I was also looking at macroeconomics, and equities is where I spent most of my time. But then I wrote an article on bonds, and I was like, I don't know bonds. I'm an electrician. What do I know about bonds? What have I even got to write? What right do I have to write about bonds? So I reached out to Greg Foss, who's a risk trader of 30 plus years experience in Canada, traded bonds. That was his life. So I sent him just in Twitter DMs this article, and I said, hey Foss, I wouldn't mind, like I don't know what I'm doing. Do you mind running your eye over this to see if it's directionally correct? And very grateful for the fact that Foss is a lovely man who gives his time for a lot of people, and he loved the article. And he said, I've actually just been contacted by someone else who was a doctor in the United States, who got in touch with Greg and said, Greg, you go on all these podcasts and you talk about all these complex terms. I don't know what you're talking about. I can't understand your language. So it was kind of like a marriage made in heaven, where you had this Sparky for this electrician who was trying to distill down these complex terms into everyday language that people could understand, get rid of most of the jargon and try and distill it down even further. And then so we started talking about what we might like to do, and this is where lookingglasseducation.com started to come to fruition. Is in and around, we wanted to write a course in and around a lot of the things we spoke about today: monetary history, barter, the different forms of money, the various trade-offs, the features. We try and score them in terms of what makes a good money. And we frame up, and it was very much an approach of a gentle orange pilling into considering Bitcoin. So we look at monetary history. We look at what are the byproducts of a fiat monetary system on you as a wage earner, debt and inflation, what they're doing. And then we finally look at the investable landscape moving forward in terms of what do real estate look like in these types of environments? What does equities, what do bonds look like? What does gold look like? And finally, what is Bitcoin? And it was kind of just this gentle orange pilling in and around, well, maybe you should make Bitcoin at least a portion of your investable portfolio. And maybe if you don't have an investable portfolio, that might be a way for you to get exposure to that. So, I've probably skipped a couple of steps here and around who else is involved. So very much later, after the doctor and I started talking about, they were the bookends of the course. That's really what we wanted to start achieving. And then very similar experience with Seb Bunny. He was writing articles as well, and Greg come across one and put him in contact with us. So it was very much Seb and I pretty much then. The doctor had some other conflicting things that he wanted to do in his life. So it was pretty much Seb and I decided to write that course with Greg's support. Greg helped us find some funding to start the platform. And then we had Dahlia Platt come on board, and Pleb Music as a filmmaker just started, contributing and helping us. Dahlia wrote the course for Me Premier Bitcoin, which is the diploma that is being used in El Salvador for their educational efforts. She's a fantastic educator in her own right, and natively Spanish speaking. So she translated into Spanish, and we built that course. So Looking Glass Education is essentially now a two-part course. We kept on that education journey. We released this course in and around why you might like to own Bitcoin. And then the next logical evolution for us was around this notion of what are the things you would need to know in order. I alluded to this a bit earlier in our conversation in and around, if you can look under the hood and realize Bitcoin's not broken, then you can ignore everything else. So if you're going to own some Bitcoin at this stage of the game, you're going to want to know a little bit about how it works, the history, decentralization, who this Satoshi Nakamoto fella is. Does it matter who he is? What's a node? What's a miner? What's public-private key cryptography? What does custody mean? And we try to, again, in our fashion, distill that down into a bite-sized, digestible, jargon-free approach to all of those various things. And we discovered after we wrote that it's actually a pretty good book. So it was always intended to be a course. And that is essentially what Beers for Bitcoin is. It's 160 pages, kind of jargon-free, written for the layperson, in and around what is it about Bitcoin that you need to understand, from sort of bookend to bookend. And it's a kind of like a wet your whistle. There's definitely deeper dives that you can certainly do if any of those topics resonate with you, but it's enough for you to get a really good gist on what this thing is and how it works. And then we basically so we released that on Amazon. That was the one way for us to maintain some funding for ourselves so that we can continue doing educational efforts, because one of our overarching themes, one of our overarching goals is to make education free and accessible to people who need it most. We never wanted price to be a barrier to entry into what we deem as pretty critical information. So that book is part 2 of our Bitcoin course. So part 1 is the why around Bitcoin, why you want to consider it. Part 2 is the what and how around Bitcoin, and it's free. So anybody can go to Looking Glass Education. You'll see the Bitcoin course up the top. And what we want it to be is the orange pilling course for people, the number one resource for people to say, if you're Bitcoin curious, your friends and family, or you want to encourage your friends and family to take the first step into their own education journey, is distilling down what is otherwise thousands of hours of understanding into essentially a few hours worth of commitment to get a really good understanding of the why and how of Bitcoin.
Right, amazing. That's really good, really great. So great, lots of information there for people to go and find out about and research, and just start, as you said, just start getting the basics, because that's where people need to start from as well. Because there's so many people out there that are just totally confused about all this. And as we know, for the last 15 years, there's been so much of the wrong information being pumped out to everybody by policymakers, by governments, by central bankers, So it's great that you are really, really doing that and helping people out there with the education. Just to touch on a little bit, okay, about the education, right? And you're into energy and things like that, yeah? Can you explain a little bit the connection with Bitcoin and energy?
Sure, love to. It's where I spend most of my time and energy, right? So I still work a fiat job, and I work on the grid. So I work in Queensland. I live in far north Queensland of Australia, and we've got a interconnected grid that pretty much goes down the whole eastern seaboard, down into Tasmania and out into South Australia. So it's what I spend pretty much all my waking time and effort on working in. And this crossover between Bitcoin and energy is a really fascinating thing, which, I worked on this every day. It was only, I come from Bitcoin from the value investing lens. It was only later on I've started to realize the energy implications on what it actually means. And interestingly, I believe it's both Henry Ford and Tesla, and maybe perhaps even Edison, have all been anticipating that currency will be directly tied to energy. So way back in the early times of electrification, they realized very soon that money would be directly tied to energy, and Bitcoin is the best representation of that. And there's a few reasons for it, but essentially, in order for us to have a finite resource in the digital realm, the only way to do that, to not be able to inflate that, to be able to control that, and be able to control the rate of release for a finite asset is to directly tie it to energy, so that it takes energy to create it and it creates energy to secure it. And the fact of the matter is that when we look back into how much computational power is getting thrown at Bitcoin, it is very clear to see that it is the most advanced, most energy intensive energy network and computational network in the world that's ever existed. And most people, without a deeper understanding of how it works, the first instinct for most people would be to say, well, using a lot of energy is bad. That's the first, we've been indoctrinated to think that energy use is bad. But what's clear to understand about Bitcoin is it is not profitable to plug in a Bitcoin miner by traditional means. So I'm in Australia. We've got actually quite high energy prices. I've got some miners that I run at home, but I try and leverage off wasted or otherwise unused energy. So I've got solar on my roof. I've got a battery in my garage. We're heavy users. We're in far north Queensland. It's a tropical environment, air conditioners, fans, and kids, right? We use a lot of energy. So it's not profitable for me to plug that miner into my wall outlet and be mining 24/7, because when I'm extracting from my grid, it's about 30 cents per kilowatt hour. And still in Australia, a lot of that energy mix is made up of coal, gas, and these fossil fuels. And they tend to be, there's a fixed price for those types of energy sources. They are normally expensive. They are normally at a per kilowatt hour rate above what you would be able to mine Bitcoins. And that's a really interesting juxtaposition, because what that basically does is it forces miners into finding energy sources that are otherwise trapped, unused, wasted, or cheap. And they generally are not fossil fuels. They are generally not coal-fired gas stations. They are renewables in more often than not. So why that's important to understand is that energy mix then. So when we look at Bitcoin mining, it often gets framed up as being a waste of energy. But at the end of the day, they're just an energy consumer. They just get plugged into a wall and they will take energy exactly like your electric car. And it's just a really good indication of that early conversation around don't trust, verify. So we get all this green framing about plugging an electric car into a power outlet. Oh, it's green, it's beautiful. Well, I plug in another electric device that just happens to have a Bitcoin miner written on the side of it, and that's bad. But it's exactly the same thing. And then when we look at how mining tends to concentrate, it's companies. They tend to build these containers, fill them full of mining rigs, and then they are looking for cheap sources of energy. And the data's really starting to come out to support the fact that most of this mining is getting done through means that are net good for the environment. And you can think about, you can have your own opinions about whether our fossil fuel issues a real issue or it's not. I'm kind of agnostic in that. I'm pro energy availability for people. That's what I'm pro, because energy consumption is directly proportional to human flourishing. And we see that time and time again. We see real poverty-stricken places in the world. They do not have access to energy. So this is really the game changer in what Bitcoin mining presents for energy grids, is that it allows you to directly tie a monetary good to the use of energy. And we've never had that before. And it's a really bold statement that warrants sort of repeating and digging into a little bit. We've never been able to tap into energy sources directly and turn them directly into a monetary good. We've never been able to do that. And that's why we tend to drift towards transmission networks, being able to tap into those energy sources where they've traditionally been. So they generally be concentrated areas with hydro generation, where you've got access to gas, where you've got access to coal. These generators have been, geographically dispersed, but you can't magically through Wi-Fi transfer electrons to one place to another. So we have transmission grids, and we've got power poles, and we've got cables under the ground to make sure that we can shift those electrons from one. And Australia's a great example. We shift electrons right from the tip of Australia on Queensland all the way down to Tasmania if it's needed, right? That whole grid is interconnected, and that is not efficient. So there's a lot of losses in that system. And where we've trended towards in the past is that those are government-owned utilities in the past. In most developed countries, the capital expenditure required to build out that system so that everybody's got access to electricity is not profitable in its base terms, and it's very expensive, and it's super inefficient. And what I mean by that is that we in the energy industry, we talk about something called maximum demand. Maximum demand is the metric by which we measure our maximum demand on the network for power consumption. And that typically resides around, in Australia, it typically resides around when people come home from work. So that period between, say, 3 to 9 p.m. with a peak around 6 to 9 p.m. is our maximum demand period. And what that represents, it's our maximum ability to generate revenue from people who are energy consumers. So, but it's only happening for a snapshot of the day. But we've got to have a grid that's big enough to cater for when we want no rolling blackouts and we want a nice, safe, reliable grid without, where that energy is available when you want it. We need to have a generation and a transmission network big enough to cater for that maximum demand when it's needed. And then we have localized peaks, like in summer. There'll be, the confluence of really hot days and that peak period through the day, and it might be a peak period through the season, is even more concentrated in terms of that peak demand. So like we expect that everyone's going to have their air conditioner on. And what most people don't understand about energy grids is we have to have generational capacity in real time available, already waiting in anticipation of that maximum demand, so that when you turn your light switch on at home, there's a generator running somewhere on your network with available capacity to be able to supply that power to you. And then when we extrapolate that out across every single person at every single home, turning on their air conditioners, their ovens, all of that sort of thing, that power needs to be available for them to be able to tap into. So what that represents, though, is a lot of waste and inefficiency. So if we've got it doesn't take much to understand that if you have, say, a floor of normal demand level, and we've got these peaks, and you need to expend the capital in order to be able to build out the generational capacity for that to be able to be tapped into at any time, there's a lot of inefficiency because that maximum demand represents your maximum amount to generate revenue. It represents the maximum amount of money that you're going to be able to bring in to pay for the capitalization, balance the economics around paying for that generational capacity to be available. And that's really where Bitcoin mining presents a massive opportunity for energy markets and energy generators to be able to tap into what is the delta between normal demand levels and what is the maximum profitable operating capacity. So you'll never push all your generational assets to operate at 100% because it's not profitable at 100%, but it might be 80%. And our normal load might only be sitting at 30% for, 90% of the day. Therefore, there's that delta between the normal demand level and our maximum profitable operating region that we can really start to soak up. And what that does for energy markets is when we have to pay for that excess capital to build out those facilities, it gets paid for either one of two ways. It gets paid for, one, directly through your consumer bill, which means your everyday price for everyday consumption is higher than what it really needs to be. Or two, it's indirectly paid by you through, there's balloons, indirectly paid by you for by government subsidies and taxation, right? So governments will subsidize these players to come into the market to build out these generational facilities on the promise that they're only going to operate 20% of the time, so that has to be paid for by somewhere, and that's generally through government subsidies. And where this really starts to come to the fore is when we look at these policies that are getting enacted throughout the globe around net zero. They're trying to push towards more and more renewables. But when we look at a traditional grid and a traditional network, it's built off rotating machines. So these big machines that rotate in a magnetic field to generate the electricity, and there's a certain amount of inertia and a certain amount of stability that those rotating machines provide. Now, when we have excess renewables on a grid, we experience this in Australia to quite drastic effects, and we call it the duck curve effect. So we've got a lot of rooftop solar penetration. Just about every residential house, commercial property in Australia's got rooftop solar. And, it was installed under the guise of making it cheaper for everyday people to lower their energy bills, right? But all it's ended up doing was making the base layer costs for the energy we do use more expensive because there's not as much competition now. And it's actually introduced another problem onto our grid where it's uncontrollable solar. We don't have control over it. And what that does is it actually puts pressure on our rotating machines, because through the day when everybody's at school, work, office buildings, our load profile is not enough to soak up the solar generation that's actually starting to occur. And we put negative pressure on these rotating machines, which is actually really, really a problem, because the heartbeat of your system is the frequency of a grid, right? So in Australia, it's 50 hertz, Euro's 50 hertz, America's 60 hertz. That's rotating. These machines are rotating, doing 50 cycles a second is basically what that 50 hertz means. Now, when we've got too much generation coming in from other sources, that actually makes our heartbeat speed up. And that's really bad for equipment, bad for grids. So we've only got a very finite band around that 50 hertz. It's actually around 48 to 52 hertz is the sweet spot before those machines start playing up, start overheating, start having operational issues. And when we've got uncontrollable solar on here and not enough load to soak up the solar that's coming onto that grid, we're actually starting to see effects on the grid. And this is another reason why Bitcoin mining is a great solution to solve that real world problem. And it's only going to get worse the more that we go out with this renewables.
So to keep it simple, if the Bitcoin miners plugged into that electricity source, they can soak that up during the day when there's lots of extra energy being put back into the grid. Yeah. And then when at 100%. Say 6 o'clock, they can just turn off the miners until 9 or 10 o'clock or 11 o'clock at night, and then turn them back on then whenever everybody's gone back to sleep.
You nailed it. And this is where we've never had a energy source that's controllable and flexible and at the scales that we can achieve it at than Bitcoin miners. So where and this is not a new term, they call that ancillary services, like controllable loads that we can introduce. So you've got supply side, which is the generator. We can control how much generation, but then the real benefit is demand side control. That's really where a lot of energy grid players want to play now, is how do we introduce and control new revenue sources onto a grid that are controllable, scalable, portable, all of these things that Bitcoin is perfectly suited to be able to suit. And the real game changer, what makes Bitcoin mining different than, say, an AI data center or an Amazon web server or a Netflix data center, is their ability to turn it off on a whim and control it with minimal effects to the network as a whole. Because we've got so much computational power getting thrown at Bitcoin now, which is evident through, all you have to do is Google the Bitcoin hash rate, and we can see this chart just keeps climbing. If I've got, a 10 megawatt Bitcoin mining farm in far north Queensland, co-located with a hydro generation plant, and I turn off for a few hours a day, it makes zero difference to the network as a whole. Whereas if it was an Amazon web server, we don't know the downstream effects of what that's going to do. If they want all of their server farms on at once, like, people rely on that in terms of, Netflix is probably a better example. If we turn off the local Netflix server, everyone's stream's going to stop. So it's not as flexible as, say, Bitcoin mining, where we know that we can control that from absolute drop of a dime. We can turn all of that load off, and we've never been able to do that in the past. The where we've tried to do that in the past is typically other load centers that take up a lot of load, which were typically things such as aluminium mill and steel mills, aluminium smelters and steel mills. But you can't turn them off in a hurry. If you've got a big vat full of molten steel, you can't just turn that off and expect it, to be off for hours at a time, because it's going to harden and going to ruin their production facilities. So they've tried to use those types of things in the past, but nothing's been as responsive and as controllable and as flexible as what Bitcoin miners introduce. And the way Daniel Batten is a good mind in this space, and he has got a really good analogy for people to really think about. If we think about a jar, an empty jar, as being our profitable generating capacity. And then we start introducing load centers and their rocks in this jar. So we put rocks in this jar, and that might be a city, it might be an industrial estate, it might be a commercial building. And we start, filling that up with smaller, different size rocks that represent the demand centers. And then we've still got all of this capacity that can be done with sand. So we'd start filling that up with sand. And that's really represents Bitcoin mining. So it's filling all of these gaps in and around that operating profitable region. And if you have a new demand center that comes in to compete with that, that gets competed out at the margin. So I mentioned earlier, we've got to find cheap sources of energy. So if you've got a real demand center, like a new industrial estate that pops up in that area that's demanding, competing for that, we get priced out. Bitcoin miners get priced out because they've got to find, there's a level there that they've got to get below. And it's normally that wasted or otherwise unprofitable region of that energy source. So this is where people say, well, it's using energy that would otherwise that could otherwise be used, and that's not the case, because they will compete at the price margin. That competitor will come into the market, and all we do is we just take out some of those rocks and sand, and we rejig it, and we put that rock back in, and we take some of the sand out, and we take that sand and we go to the next empty jar and we start filling it up there, because a lot of these are portable. They're containerized solutions.
Yeah, amazing, amazing. So basically, Bitcoin is great for energy, and it's great for it's going to be great for everything. And last year as well, I was saying, because of the flip now with who's after getting involved in Bitcoin through the ETFs and BlackRock and all these big asset management firms, the whole narrative about Bitcoin is going to change so fast. And we started seeing it straight away in January. I mean, Bitcoin's going to be good for the weather. It's going to be good for energy. It's going to be good for the environment. It's going to be good for your granny. It's going to be good for your pets, probably. You know what I mean? The whole narrative is going to change, isn't it?
Yeah, and I think like the opportunity here, this is such a good point, that the narrative shifted in terms of like if BlackRock. So when I've tried to approach the Australian government, because I mentioned earlier that all of our energy is pretty much government owned, all of the infrastructure is government owned, and when it's a government owned entity, profit's not always the bottom line. They've always got these other social agendas or environmental agendas. So profit's not always the thing that speaks to those energy operators. So when we've tried to bring this up in the past, as soon as you mention the word Bitcoin, the conversation stops, because they still look at it like a scam. They still see it co-opted with all these crypto assets. And that's why I'm so vehemently against that, because it starts to impact the narrative in and around what I know Bitcoin can do for consumers of energy, for ratepayers, for bill payers, for governments, to improve those economics. So when you go down, you sit at the table to have these discussions, as soon as you mention the word Bitcoin, it gets shut down, because they're just not interested. And as a government, they can't be seen to be, whatever benefit it provides, they can't be seen to be, co-opting with scammers, right? And that's where I think the narrative is going to shift with Bitcoin, because we are starting to see this, this bifurcation of that co-option with crypto. And I think, if anything, the ETFs that launched in the States only add better weighting to that as a legitimate asset now. If BlackRock is offering it to all of their pensioners and all of their investors, then maybe it's not a scam. Maybe there is something underlying with this asset that separates it, and that discussion just becomes more palatable by having a lot more institutional weighting in and around this as an asset. And maybe it's not a scam. Maybe I do need to pay attention to this. And I think it just helps us open up those types of conversations.
Yeah, definitely. Amazing. Daz, you've really opened up my eyes anyway, and my mind, to energy and Bitcoin and different other things as well, what we talked about. So if somebody wants to get in touch with you, because I like to keep these about an hour, we'll have to go way over there, but no problem.
Sorry, mate. Yeah,
no problem.
I can rant. No one can rant like me when I get going. So if anyone wants to get in contact with me, you can find me on Twitter at Daz Bea, Dazbea. Same, I think you'll find me Daz Bea on LinkedIn if you want to connect. More than happy for anybody, and lookingglasseducation.com. So yeah, feel free to reach out if you want to talk energy and grids, and you've got something in mind, you want to know more, or anything in and around custody. More than happy to have a chat.
Perfect. Thank you. And you get them there. Thanks you. So thanks for your time.
No worries, Larry. Thanks, mate.